Could the right bond fund be the secret ingredient to securing your financial future? Let's take a closer look. Welcome to the channel. Every day I explore personal finance questions that real people are asking on Stack Exchange and highlight the top answers from the community as well as any key takeaways. If you're new here, consider subscribing for daily videos just like this one. All right, let's take a look at today's question. Today we're exploring a common question. How do you find the right bond fund? Here's the original question as it was posted to Stack Exchange. I'm going to scroll through it quickly so you can see the whole question, but feel free to pause the video if you want more time to read it. Don't worry. After this, I'll walk you through the key points of the question so you get the big picture. So, in summary, someone's on the lookout for a long-term corporate bond fund, or ETF, that offers total returns over 5% most of the time and has a management fee under 0.25%. But they're hitting a wall because no fund seems to fit the bill, and they're curious about why that's the case. Here's the top-rated answer from the community on Stack Exchange. I'll scroll through it quickly so you can see the full answer. Feel free to pause the video if you want more time to read it. Don't worry, I'll highlight the key points of this answer in just a few moments. In this answer, it's explained that yield to maturity is different from total return because it doesn't account for price changes due to interest rate shifts. Long-term bond funds can be volatile, especially when rates rise, making consistent 5% returns tough without adding risk like junk bonds or leverage. Now, before we jump into the next part, if this video has been helpful so far, be sure to tap the like button and subscribe to the channel. We post new personal finance videos every day to help you make smarter money moves. All right, now that we've seen what the community had to say, here's our take on this question. Consider using a barbell strategy with bond funds by mixing short-term treasury bonds with long-term corporate bonds to balance risk and return. You might also explore target maturity bond ETFs, like iShares iBonds, for more predictable returns. Additionally, buying individual A-rated bonds and holding them to maturity can give you more control over your returns and lessen market rate impacts. In this video, we've covered how yield to maturity and total return differ, with total return accounting for price changes from interest rate shifts. Long-term bond funds can be volatile in rising rate environments, impacting returns. A barbell strategy, combining short-term treasuries and long-term corporates, balances risk and return. For more predictable outcomes, target maturity bond ETFs and individual bonds offer better control over interest rate impacts. Thanks for watching. Before you go, did you learn something new from this video? If so, be sure to drop a like on the video to let us know.